Hey traders, I'm Delgado, Mike Stats commentator at the Global Prime Forex. I just finished an interview with Greg Rubin. Greg is a senior trader for Global Prime, specializing in Elliot waves and Fibonacci technical analysis. Let me tell you, you do not want to miss out on this one. It really is full of golden nuggets that you will be able to enjoy from the beginning to the very end. So before I jump into the chat, let me give you a brief introduction about Greg. So Greg is an experienced and knowledgeable trader with an impressive track record of over 13 years across various asset classes. Greg also started, let me just give you a bit of information about his beginnings. He started his career as a prop trader, trading fixed income. He then moved over to the equity side before spending 10 years at a precious metal firm in London. He was then head of trading and responsible for providing daily market analysis, writing research reports, as well as executing trades. Greg also shares trading tips and wisdom that he's gained over the years. To top it off, Greg, remember, is one of our mentors in Global Prime's Mentors Room. Enjoy the interview. Welcome to the show, Greg Rubin. Remember, for those that have been following us for quite some time, Greg is a senior trader for Global Prime, specializing in Elliot waves and Fibonacci technical analysis. How are you, Greg?
I'm very well, thank you. How are you, Ivan?
Thank you for making the time. I know that you made sure that you would be, you were very specific about the timing of this interview. So there's going to be no interruptions, no background noise. So I understand you're still in the office in Sydney right now?
Of course.
Fantastic.
Yes.
Okay. So, it talks very highly of you and the value that you want to deliver today in the interview. So let's get to the nitty and gritty of things. So every single trader has a story about how they became interested in financial markets. Do you mind sharing with all of us what's yours?
Sure. My story is actually quite straightforward. As a kid, I was always interested in markets. Maybe I liked money at an early age. And then when I went to university, I studied finance, and I found myself obviously enjoying the markets. But what I really took up at university was poker. And I found out I was very good at it, whether it was online or whether it was playing live games. I tended to enjoy the sort of reading people, probabilities, knowing when to put your money in, so to say. And the similarities are quite similar to the market. So I actually, in my second last year of university, took up stats as a major on top of my finance honors degree. And when I finished university, I was fortunate enough to land a prop trading role. And I took the role, it was in Cape Town, on the premise if I was any good, they would transfer me to the London office. And after about 7 months, I got transferred to the London office. And from there, it's pretty much been plain sailing since. Haven't looked back.
Fantastic. Yeah, I believe that, having studied statistics really makes or reinforces your appeal towards the markets, because it's a very statistically approached game, right, in a way?
Yeah, well, I mean, I think that's often a misconception that many traders have when they start. They think that they need to call the market right every single time, when in essence, as you mentioned, the markets are a game of probabilities, and you want to place your bet when the odds are in your favor. And as soon as the market tells you otherwise, it's time to get out. So definitely, for me, the markets are probability based, and I always put my money down when the odds are in my favor.
Yep. So let's get to the nuts and bolts. What's your trading methodology in a nutshell? If you could just, whatever you feel comfortable sharing, of course.
Sure. So I'm a technical analyst. I'm skilled in various forms and have studied various forms of technical analysis. But for me, my preferred methodology to analyze markets is Elliot wave. And I use that using a Fibonacci's as a complement to my strategy. For me, I think when you truly understand the power of the two of them together, sort of knowing where you are in the market cycle and having levels or extra levels of support and resistance, I definitely feel it gives me an edge.
Yeah. And for how long have you been actually using this strategy, and how that strategy has evolved over the years?
So it was 2011, where just before gold was topping out, I came across these articles by an Elliott wave analyst, and it kept calling for a top in gold. And I was sort of blown away by it. I won't say skilled, but I knew what I was doing in the markets, but I couldn't understand how, with all the hype that was going on, euphoria, in essence, with gold, with all the printing of money, how he could ever foresee a top. And of course, gold topped out at 1920 or 1919. And I became more and more interested, and I started studying it. I started reading books up. I did everything I can to try and understand on how such a call could be made. And throughout the years, I understand now the methodology and how it all works. That's what fascinated me and got me involved in Elliot Wave.
Yeah. Was there any mentor of yours that actually you could be thinking about as to give the most credit, or was just like a personal exploration for you to grow as an Elliot Wave / Fibonacci trader?
Yeah, well, I mean, I took the premise and then I studied in depth. For me, after, I won't say messing around, but after sort of looking at different points, I read the Elliot Wave Principles, which is the Bible for Elliot Wave traders. It's just quite simply, it's by Frost and Pretscher, and it's quite simply just a detailed explanation of all the different patterns that occur, all the different rules, the guidelines. And I started from there, and I started looking at webinars and whatnot, and I really taught myself it over the years. It wasn't, like I said to the guys in my Discord room, where they're all learning it at the moment and they sort of sharing questions. I never had anybody I could just type a message to or ask a question. So I definitely think I did it the longer way around. But I'm happy to say I've now been doing it for 9 years or so. Yeah. And I think the results speak for themselves. I've definitely been able to profit in this market using my strategy. But I just want to add that while we sort of talk about, Elliot Wave and, its merits or whatever, the truth of it is, it doesn't matter what system you use, Elliot Wave, any other system, if you do not have any risk management, you will not make money in this market. So it needs to be utilized with risk management. I learned the Elliot Wave first, and it took me afterwards to think, well, it wasn't working initially until I got myself in order and studied all the different risk managements. And again, I got a methodology that works for me, trading the markets, but first and foremost, it's risk management.
Yeah. So let's get to that question specifically. What are your risk management rules? How much do you risk per trade? Do you have a specific, drawdown that you would never allow yourself to go, beyond that per week, per month? If you could just kind of elaborate and break it all down, it'll be great for those that are viewing this interview.
I mean, how long do we have to discuss this?
Maybe just in a nutshell,
I'm joking. I'm just joking. Basically, I'm trying to emphasize how important risk management is and how many different rules that I do have. But in essence, let's go to the basic or the most important ones. Is I have a set amount that I can lose in a day if I'm day trading, and if I lose that amount, I'm done for the day. For every trade that I take, I have a set amount. The sort of sweet spot is generally between 1% and 2%. For me personally, I tend to be closer to the 1%, often probably a tiny bit below that, but that's the sweet spot for me. Anything sort of between that and 2% is acceptable. And I think the biggest thing for me is I define risk. I look at risk before I look at reward when I enter a trade. And what I mean by that is, a lot of people, let's say, buy gold at 1900 and they think, well, if it's going to 2,200 or whatever it is, that's how much money they can make. I look at it from a different perspective. I say, well, where am I wrong? And if I'm wrong, let's pick a level, say 1850, I know I'm risking $50 for my thesis to be proved wrong. And I then work back. I go, well, if I'm risking $50, what size do I need to enter? What position size do I need to take so that I'm only risking, call it 1% or whatever percent it is? So I know straight away what my risk is, how much money I can lose on the trade. And I'm okay with that. I pick a level that I'm happy with, that suits my risk, that is in line with my risk criteria, it's in line with my parameters, and that's the size that I take, as opposed to using a standard size for every trade, and they just pick a random stop loss or put the stop loss at 1850, then go, oh wait, I wasn't supposed to lose that amount of money. Yeah. So I look at it almost as a sense that money is gone, so to say. I've taken the trade, I've taken the risk on, I'm happy with it, all planned beforehand. And that's, for me, is the way that I manage my risk. It doesn't matter how much I like a setup, I will not risk more than 2%. That's the absolute max that I will risk. But generally, I am closer to the 1% mark.
Yeah. And do you set a fixed take profit target, or that may vary? It's variable depending on the context of every single market that you're trading.
So I personally don't like to set limits, so to say, automatically, but I always have a price target before I enter a trade. So I know where I'll be targeting, but I won't set a limit unless I'm going to bed at night, and I might set a limit, or if I'm scalping or whatever it may be, if I'm busy and I can't monitor it. But generally, yes, I know exactly, I work out what price, the reward I'm looking at my target, I'm looking at the risk, and only if the mathematics make sense will I enter the trade. So if I'm only looking for $30 and I've got $50 risk, the trade doesn't make sense to me. So do I have a specific percent like risk reward? I don't, but generally, as we'll sort of get into, I look for sort of 1-2 setups in Elliot wave, or 1-2-1-2 setups. And in essence, it's usually 2-3, can be even up to 10-15 times, depending on the specific trade or the time frame we're referring to.
Yeah. And thinking about your approach to the markets, would you consider yourself, for the most part, to be someone who engages in a micro level, low time frames, or more kind of like bigger time frames?
I trade all time frames. And again, the system that I use, what I find so powerful about it, probably it takes people to realize this at first, it's not the predictive power of it, which of course, as you know, I do love, I'm not shy to say I do like it when I bottom tick or top tick from time, but that's not what makes money in the market. What I love about it is it tells me where I am in the cycle. So I know, for example, when I said gold was in a fourth wave and we're going to be in a sort of sideways choppy market for a period of time, I know I need to take profits quickly. I know X, Y, and Z, what I need to do in those market conditions. So then I'll go into smaller time frames and you'll see me scalping a lot more. When I'm setting up for a third wave or fifth wave of metals, which I'm looking for at the moment, I'll tend to swing trade a lot more. So it totally depends on where I am in my roadmap on how I attack a market. Like I said, third waves, I'll get my positions in, and then I'll be buying intraday dips. I'll be playing in the way of the trend. I always like to be in the direction of the trend. If I am counter trend trading, I do tend to reduce my size, and I take into account that I'm going against the underlying trend of the market.
Correct. Now, thinking about your routines as a trader, from the moment that you wake up and check into the office until you check out and call it a day, what is it like?
I don't want to scare people.
Go ahead, scare us to hell.
I'm a hard worker in the sense that, not that I need to be I do need to be a hard worker, but not that I need to always watch the market. But if I've got positions on, I like to watch them probably more so than I need to. It's just my nature. So I'm up probably around 4:30 every morning. And first thing I do is I have a quick scan of what happened in the overnight market, have a look at my chart quickly, say good morning to my Discord group, have a chat with them to see what's happened. Normally by around 6 o'clock, 6:15 latest, I'm at my desk and I'm looking at my charts. I'll spend about an hour going through all my charts, if any of my alerts hit overnight, basically getting myself mentally ready for the day. I'll spend an hour just going through everything. And after that, again, I'll be engaging with my room, and my views. I share a daily analysis. I'll put out my views on the market, and then I'll go about my day trading the markets. And normally about 6:30, pushing 7, I'll leave the office and I'll take a couple hours off, and then I will chat to my Discord group, see where the markets are at that time. And if it's going to be a busy evening, I will try to stay up and trade the US markets. Otherwise, more so these days, I have been sort of retiring to bed around 10:30, 11 o'clock after I've been through all of this. So that will be a typical day for me.
Do you tend to completely disconnect from the markets over the weekend, kind of like setting hard rules about, because you're so heavily involved in the markets from Monday to Friday, you definitely need a bit of unwinding, I suppose, right?
So my weekends are for relaxing.
Yeah.
I do try and completely switch off from the market. Um, I say complete. I never completely switch off out,
Pretty hard.
but I do.
Yeah.
Yeah, I do try to just relax myself, get myself mentally ready for the week, and it's definitely something I do
Yeah,
and
and
need.
I think that your daily routine pretty much resonates with what, as an external observer, I've been able to firsthand experience myself. You are very involved with your community, and for those that really want to be reminded of, this is, I suppose, a great opportunity for those that really want to join Greg's mentorship. You can find the link in this video interview. So if you are they going to have a free trial if they wish? Is there
Yeah,
still available?
there's a 2-week free trial
Okay,
for any new members who decide to join.
fantastic. Now, I wanted to ask you, I was quite interested about, do you require any specific market conditions for you to, for your trades to thrive? Talking about, waves 3, I know that you are pretty adamant to actually be heavily involved in the market when it comes to wave number 4, which is much more choppy in nature, right?
No, I like to be heavily involved in the third wave, and then the fourth waves, I tend to move into scalping mode and just look for extreme levels.
Yeah.
I definitely change gears, so to say. So
Yeah.
no, I don't need any specific conditions to be successful, but more so I know where I am in the framework. So I know when to expect big moves, when to expect the large move, when the market is ranging. So for me as a Elliot wave trader, as a logician, the third wave and fifth waves of metals are the most powerful waves. And those on a larger degree are the ones that I want to really be involved in. I don't want to be heavily involved trading the chop like we've seen in gold in the last 2 months. But I do switch gears and I'll intraday scalp and I'll look for 5-10 points here or there. So my trading strategies differ depending on what wave we are in. So I don't think it's important to be successful, but I think it's important to identify where you are in the cycle and where the easy money is or easier money is to be made and when conditions turn tough. And I think that's another part of the system that I do really like. It gives me that sort of clarity of where we are in the cycle, what gear I need to be in as a trader.
Yeah, and what type of gear are you at whenever you are going through wave 3? Are you becoming fairly more aggressive in your trades, in the position you put in, just because you know that this is not the type of market that is going to be, for the most part, choppy, but rather directional?
So rule number 1 of a wave 3 is do not lose your core position. So what I do is I position myself, or I try my best position myself after the 2 to get a core position that I'm comfortable to hold throughout. Those are positions I will not sell. And what I'll do is I will hedge at certain points where I feel there's risk, or on pullbacks, especially the intraday pullbacks, I'll just look to buy the market. Because third waves, you could see what we saw in silver. We'll get to that chart. We pushed all the way up to just above the $30 mark, sort of $10, $12, whatever it was from there. Looking at gold, the way we shot from the 1500, 1600 up above 2000. So you do not want to lose your core position when you're in the third wave. It's something that, you get scared intraday. Often you'll see the market drop heavily intraday, and by the time the day is up, it's back in green again. So I keep my core position and I'll scalp around it or I'll hedge around it depending at, certain parts within the third wave where I feel that there might be risk, but I will not sell my holdings.
So let's get to a key question that everybody is obviously, pending to get a response from, and that is the US election. Obviously, we are around the corner. It's happening on November the 4th. What is your view in the outcome of the US election? And let me follow up with this following question. What's your technical read telling you when it comes to US equities, gold, and silver? And here, if you want, you can start switching into screen sharing if you want to share your views into it, as you please.
Sure. Can you see my charts?
Yes, I can see gold versus US dollar 4-hour time frame.
Yes. Okay. So getting back to the actual question at hand, what's my view on the US election? Do I know who's going to win? No. The polls and bookies have Biden as the favorite right now. But
does it matter?
no. I honestly do not think. I honestly think whoever gets in, it's not going to affect the markets besides a potential knee-jerk reaction.
Okay.
And you can go back to the last election where it was sort of, I say, common knowledge. The talk on the town was a Trump win means stocks collapse and gold goes much higher, and a Clinton win meant stocks go up and gold collapses. And what happened on the night of the election when the results started coming in, you saw a huge move higher in gold and stocks were collapsing, and everyone thought, well, of course, that is what was expected. And I mean, I remember clearly, and I'll share the story with you a little bit later, that stocks ended up being limit down at one point. And when the market reopened, it just went straight to the upside and never looked back. And at that time, gold and stocks were trading in inverse. I do not believe they always trade in inverse, which is another whole discussion. And then we saw gold drop quite heavily off that, obviously later recovered, but it was stocks that just took off from there. And everybody was left confused because we were all told, or everyone assumed that a Trump win was bad for stocks, which clearly was not the case. So I'll say the same thing again, and it's ironically, I said this to my group earlier, the way the S&P is set up, it is set up for a potential downside move, and that could coincide with a Biden win before we sort of turn around and go much higher. So let's get into the charts. So I'll start off with gold. This is my gold chart, and you can see here we have it's a 4-hour gold chart. Mm-hmm. Here we have the Corona lows. We saw a nice clean 1, 2, 3 waves up so far. And what we have been is consolidating in this 4th wave. Now, you will know at the time when I sort of joined Global Prime, we were trading around, we were in this chop over here. Mm-hmm. And I was positioning myself for the 3rd wave, and everyone was calling me an Uber bull. And I chuckled to myself saying that I only see the market in one way. And then we got this launch out of this sort of 2nd wave, second of the 3rd wave, to complete this. And as soon as I saw the market breaking down here, you would know I called out that we're going into a 4th wave now and to expect whipsaw chop for the next few months. And that is exactly what we have seen here. So this chart, I mean, I drew this box over here when the market was over here, expecting this exact pattern to sort of fall.
What does the box represent, this purple box?
So I'll get to it now. So what the purple box essentially represents, this is where I expected the correction for gold to end, between the 1760 level and the, well, I can't see, our pictures are covering it at the moment, but it was around the 1855 level.
1847 to be precise, I believe, more or less.
Okay, there we go. So this was the box I was expecting before we move up in a 5th wave in gold towards the 2,250, 2,300 level and potentially beyond that. As I mentioned, 5th waves in gold are generally very strong, and we often do see extensions. So I would not be surprised to see levels sort of to higher levels than these standard expectations. So let me just take you into some reason on how I got this box. One rule we do know with Elliot wave, or one guideline, should I say, is we know that the wave 4 is generally retraces the 0.382 to 0.5 of wave 3. Okay. So if this is my wave 1, this is my wave 2, and this is my wave 3, I want to draw this to see what fibs we hit. So if I just draw this here quickly for you from there, and I can draw it to the top there, I know we should be, okay, it's close enough for now. I know we should be between 1864 and 1805 to end this correction. Mm-hmm. So this was a sort of level I was looking at between those two. I also know the relationship between an A and a C wave is often the length of A equals the length of C. So if I draw from the bottom of A, so I'm drawing from here to here, I want to see this length, the A wave down. If I draw that length there, and I transpose it, so I move it to the top of B. Okay, it's accurate for now, not quite accurate, but I'm just sort of showing the premise. I know that 1807 becomes a target. So look at the confluence we have in this area. I have 1807 with this method, with the A equals C, and I've got 1805 looking at the sort of standard retracement. So
Which
for
happens
me,
to be
this
the 50% retracement, right? Yes.
correct, the first rate. So for me, of wave three, not of the whole structure.
Yes, the wave three, yes.
So for me, I've got huge confluence in this area. So this 1805, 1807 for me is a significant area where this market may attempt to, well, I was looking for it to attempt to bottom it and get us going on our fifth wave. So I was looking when we're coming down here, ideally looking for that 1805 level, 1807 level to hit. And what's happened is we've stopped over here and we've formed the structure of the low. Now, I'm not in love with the structure. I would have loved to have seen an impulse form because as you can see, we hit the top of my box, just about that I was looking for.
Do you also need the time to coincide? Do you need price plus time to actually hit that box, or it can happen ahead of that box being reached time-wise?
For me, I've never been someone who's used time purely because I know many cycle guys. I know many people who do use it. Elliot Wave does have a way to work out time. But for me, it's never more than 50% accurate, and I can't use that to form a thesis. So I prefer not to look at time. But then again, I do, I'm in touch with cycle guys who sort of give me their view on the cycles and see if that coincides with my analysis. But it's very much secondary. I'm not too concerned with time, if I'm honest. Especially with these structures, it could form a more complex correction. It could sort of go, up and up, and then all of a sudden time elapses based on the structure. So I do know when the big cycle dates or the big turn dates are, but that is very much secondary for me. So this is where we are right now. Ideally, that 1805 level is a target if we have not, in fact, bottomed. Now, I would have loved to have seen a clean structure out of this low to confirm that we had a bottom or signs of a bottom. But what we actually have here is so 5 waves is what, without going too much into it, 5 waves determines the nature of the trend is an impulsive move, and 3 waves is a corrective move. And what we have here is a diagonal high. I can make 5 waves on a smaller time frame. I can show you more clearly. Where we actually have in a diagonal form. It's called a leading diagonal in Elliott wave terms. Now, not reliable structures, but I'm giving the bullish thesis the benefit of the doubt. And what I have been doing here is I've been looking for points to take longs to try and catch the big swing trade into this area. So I called out live where I went long at the 1874 level. It was just on this low when the market was coming back to try and catch the swing trade. And I have a break-even stop on that right now, which I don't mind losing those profits. You don't always get a swing trade first time around, so to say. You often have to take a couple shots, and I know I'm looking above the 2-2 level. So I'm not convinced by the structure that the low is in, but I'm giving it the benefit of the doubt. And as soon as I get micro setups, I am stabbing to the long side to try get myself in a position. And if I do catch it, I most certainly, as I said, will not lose my core position. I will hold on to that, and I'll look for intraday dips, or I'll look for the next stage of the micro, the 1-2 setup, so to say, and look to build on my position. So
Perfect.
I'm treating it like the low is in. I'm trading that way, taking small attempts, but maybe in the selfish way, I'd love the market to go towards 1800, or maybe in a quick scare touch below there. Because this, to me, whichever form of analysis you use, is an incredibly bullish structure. You've got a strong move up, and you've just had sideways chop for the last 2 months, while the techs have completely reset themselves again.
Yeah. So briefly, what would it take for this premise to be negated?
Okay, so I do have an out counter, which I always have at all my whichever charts I look at. I've taken it off this chart because I didn't want to clutter it, just to keep it clean. But in essence, I need to see a 5-wave move. Right now, we've only got 3 waves up. So I need to see the 4-5 to tell me which way the trend is, the direction of the trend. So to have a non-overlapping wave, essentially, you can see where my 1 is. The 4 should not go into 1.
Okay.
It can if it forms a diagonal, but I'd be very concerned if we see 1641 before we see the next leg higher.
I understand. And what about this number 2 in isolation on the bottom right-hand side? Would that be your projection once we reach wave 5? Or
yes. So this is a loose projection right now because I don't know where we're going to top.
Yeah.
I've built this in based on topping in this region. So as soon as the market tops out in the big wave 1 to complete the primary move higher, I'll be expecting a wave 2 correction to take place before the market attempts to push higher again. So this will be changed. If we extend, the further we extend higher here, the higher this number will go up. So it's just on my chart have it on my chart as a basis, but like I said beforehand, fifth waves to metals, more often than not, they do extend, and I would not be surprised to see an extension to the upside above standard targets. But that I'll work out and look at the time. So should we go into silver?
Yeah.
More questions.
So silver, and then if you got time, use equities as well.
Yes.
Yeah.
So here's my silver chart. Slightly different degree, and this chart does allow for slightly further interpretations, which again I've taken them off the chart to show my primary and to show not to clutter it. So same sort of move at a nice 1-2 setup. That's the 1-2 I refer to, and a nice extension in the wave 3. Again, it's perfect ABC, which ideally completed that last low. But just like gold, we have that same leading diagonal structure, not an impulsive structure off the low. So I allow for a further move inside my purple box before we sort of push on to the fifth of the third and the fourth and the fifth higher. But at the same time, like gold, I'm giving it the benefit of doubt that we have struck a bottom, and silver definitely has gone deep enough. So I'm watching the structure closely, and I'm looking for longs against certain levels intraday to try and catch the swing trade. But this is just looking at a macro basis. Of course, my micro is a lot more detailed and a lot more sort of in depth, like all these little squiggles I have numbering and letters for. But the gist of it is I'm expecting silver to get towards a $38, $40 level, if not higher, before we begin the wave 2 pullback. So I'm incredibly bullish silver on a macro basis. On a micro, giving the benefit of the doubt that we have in fact struck a bottom, but I can make a case that we might go for one more scare into the box. And for anyone who does trade silver knows that silver does like to scare you before we go the other way. And you can look at this Corona drop. We were, $18, $17, and we went a straight line down to sort of the $11 level before we ripped higher.
Yeah.
Looking at the SPX.
Yeah, SPX.
So slightly different structure. I have a beautiful completed 5-way structure off the low. So here's our Corona low and a lovely structure. And slightly behind, I think we have just completed, we have completed the A wave of the correction, and have just recently topped out in the B wave. And I'm expecting a drop into this purple box before we continue higher. Now, not shown on my chart, before I go into this, I do have an alternate count, and it does say that this A is in fact the bottom of the market. This was the bottom of a second wave. Now, if that's the case, it would be incredibly shallow. So I do think probability-wise, I would love to see the C wave down and at least provide that scare that markets often do in the second wave. Right now, it seems every dip gets bought, and the sentiment is just incredibly bullish. So as long as we remain below this B wave that we struck earlier in this month, I would like to see this market unfold to at least the 3,000 level. And even that would be shallow, but at the end of the day, this market is acting incredibly strong. So it wouldn't surprise me towards the top end of my box. But realistically, if I look at sort of if you use standard measurements from this 5-wave structure, you're looking around the 2636 level. But even I think that is unlikely with what we have been seeing in the incredible bullish nature. But I would love to see a quick C wave down. And that perhaps could coincide with the elections. Perhaps Biden wins and we get an initial scare into this box before we continue higher. But once we complete this second wave, whether it's in here or it is complete already, I'm expecting at least 4,500 S&P, potentially even as high as 6,000 before we complete the fifth of the fifth and complete the move higher in stocks. So whoever wins the election, I'm incredibly bullish this chart. I just would love to see a scare down to at least 3,000. But either way, I think once this correction completes, or if we do get a fifth higher, I'll be looking probably to buy the pullback around here. I do think we're going to at least the 4,000, 4,500 level, if not higher.
Yeah. And you are not someone who shies away from making, let's just call it, controversial calls. I understand that back in August 2018, you made a controversial one by declaring the bottom of the gold market, despite it was, dropping like a, it was incredibly bearish. And you managed to correctly call the bottom on the day it bottomed on, I believe it was 16th of August at around 1,160. Can you tell us how you knew, what made you so confident about that bottom back in the old days?
So I was looking for a bottom. I was looking for the market to bottom, and it was banging my support zones. And I was actually so the market opened up. I was living in London at the time, and the market opened at 11 o'clock London time. And I was watching at...
Is there any chance that you can represent through the chart that moment on August 2018 so that people can actually have a bit more contextual setting as we discuss about this August 2018 bottoming goal? That'll be great.
So let's go back.
There you go.
So here we were. This was the bottom right here.
Mm-hmm.
So I was looking in this region for the market to bottom. Again, I don't have the fibs on my chart and whatnot. This is, I wasn't using this charting software at the time.
That's fine.
And I was watching this structure, and it opened up. This is the tail that we saw. It opened up, and I saw this liquidation event. It was just, gold was gapping. It was dropping. I was dropping $2, $4, $5, just in a straight line. And I looked at that and I thought, this is absolute complete liquidation. And I went to bed that night. I saw the rebound higher, saw the tail higher. I went to bed that night and I said, right, gold's bottomed. And I used to write research reports that went out to the industry, to quite a number of people. And I wrote a report that next day, which I've still got, it's still all in writing, declaring the bottom of gold in. And the disgust I got, people thought I'd lost my marbles. You look at the structure thinking, how do you know that this is the bottom?
Exactly. I was about to ask you, what's the technical merit for you to call that bottom?
I was looking for the zone for the market to bottom. It hit the level, I think about $5-6 lower than ideally wanted, in a complete liquidation event. The market was just, there was no bids, went straight through, and then caught a V-shaped bid straight higher, immediately recovered. What this chart doesn't show is it recovered straight away and then spent sort of a lot of time meandering at the higher end, and then we sort of kicked on from there. But you should have seen the replies I got. People thought I'd gone crazy. They were thinking, well, who is this? How's he calling gold bottom? Gold's so bearish. It's easy now looking back where gold is, but the sentiment was so bad. And if you look at what we've had, we had a bounce the 2015 to here, the 2016, we had a bounce, but we were just downtrending. But in essence, this is where I considered the low in, and here I had the structure that told me that the 2016 was a lower high to be bought, and this was the ideal level. Saw the liquidation, wrote the article, and I don't think I've done too badly since.
Yeah, that definitely represented a historical bottom that is still in place to this day.
Yeah. I've got it in writing if anybody wants to see it. I definitely kept that article I wrote.
Fantastic. Is there any other chart you'd like to share, or would you like to shift gears? Do you have anything else?
Let's shift gears.
Perfect.
Let's shift gears.
Okay.
I'm happy with that.
So if you don't mind, just stop sharing the screen, and then we just go back to the gallery view, just the two of us. And I also wanted to ask you, I was interested about your perspective about, what are some of the good habits or best practices that one must develop as a trader, either it is commodities, Forex, stocks, you name it. And similarly, what are the bad habits that you believe people has to, get rid of to really have a chance at this industry?
So, it sounds silly, but discipline is so important. As a trader, we need to avoid the big losses. Those are the ones that kill accounts. And as soon as you lose your discipline, those sort of losses creep in, whether it's not having a stop loss in place or not calculating your risk or going, I'm just going to take a quick trade without doing the math. So, putting the, just deciding to take a trade on the fly, and then it turns into a big loss. you need to maintain discipline. Like discipline is so, so important. And you need to have your rules, you need to have your strategy, and you need to stick to it. As soon as you vie away from it, or just this time, or I'm just going to do this, or I'm hungover, I'm placing a trade, is where things go wrong. So discipline is paramount. Patience, I look at the older I've gotten, the less trades I take. I wait for the market to come to me. I wait for those good setups. Where a lot of new traders specifically think they've got to trade every single squiggle. Every time the market moves, I think they need to trade every 5-minute move, and the essence are just gambling. So definitely having patience, definitely, letting the market come to you. And for me, which I advocate for everybody, I know we've had a chat about this, I know you agree, is the fact to reconcile, to analyze all the trades that you do. So every time you place a trade, you make a note of why you bought. So you know the reason, and at the end of the week, review it. Not only can you see, well, this setup made me money, this setup lost me money, which setups work best for you, it actually stops you doing stupid things because you have to go and review it. And nobody wants to review, I lost my cool, I was on tilt, and I started clicking buttons and I started placing trades for no reason, but I was upset that my last trade got stopped out. So it actually helps you become more disciplined. It helps you actually stick more to your plan.
Yep.
So those are 3 important things, I think. What to avoid? Yep. Ego. I think a lot of traders have a big ego. They come into the market thinking that they're better than the market, that they're on a good run, look how big I am. If you have an ego, the market will clean you up. The truth is the market does not care about you, my feelings, doesn't care about anybody. It's a cruel mistress. And you need to be on your game. You need to be neutral. You cannot go in there thinking you're better, because you will find out the hard way. So I think you need to accept you're not going to get every trade right, accept you get stopped out, and don't take it personally. Don't let your ego get in the way of your trading. FOMO is a big one to avoid. Bitcoin, let's talk about that at the moment briefly. As soon as it goes up and it's flying higher, everybody just goes, oh my God, I don't want to miss it. I have to get in. Mm-hmm. Same with stocks, I have to get in, and they just buy it. And then they've got caught up in all the noise and the hype around it. And then the market tends to top out and go the other way, and you're left confused buying at the top. So FOMO is imperative to avoid. It is something that kills traders. They wait for the market to go up. It keeps going up. Everyone's talking about it. And then you jump in because you panic in. If the market goes without you, there are many buses, there are many setups. Miss it, leave it, and catch the next one, or wait for a pullback. Wait for the market to come back to you. Do not go chasing the market. And I'll just add one more again. I think it's important is the squiggle trading, that sort of degenerate gambling, so to say, is the need to always be in the market. As I've said before, I trade way less than I used to right now because I'm stalking, I'm watching the market, I'm waiting for those good setups. I see it a lot in my group as well, where it's what's happening here. Should we buy here? Should we do that? And I'm like, we're still within this wave. We're still in this degree. It doesn't matter. Just let the market play out and wait for the edge and then place your bets. You don't have to trade every single little move in a market. So I think, I'd say avoid over trading.
Yeah, that kind of adrenaline seeking feeling is something that can be a major killer for traders if they are not looking after it.
Well, that's what you find. You find that you end up trading because you want the adrenaline rush.
Correct.
You're placing bets because you can't not be in the market. And, you want to be long a market, and then it keeps going higher. You think, well, I have to get in. And then it turns and you go, oh, I have to get out. Then I have to get in. Because to be successful, you need conviction. You need to have the good setups. You need to believe in the setups. Mm-hmm. Otherwise, if you're trading every squiggle, as soon as the market sort of flips against you or goes slightly down, you panic out. And you end up placing 5-6 trades and the market's moving a $5 range because you just need to be in the market. So it's absolutely imperative to have that discipline, have your setups, have your strategy, have your rules, and stick to them. Do not go chasing or do not bet in a market because you need an adrenaline fix. You will find out that you will not be profitable.
Yeah. All these advices are definitely gold, and if people do not respect them, they're definitely going to get burned out by the market. And not just to stop you there, it sounds so obvious. It sounds, of course I'm going to have discipline, of course I'm not going to do this. But when you're in the heat of the battle, when you're in the market, when you're staring at screens all day,
it tends to creep in, and that's why you need to stick to your rules, and you need to understand that this is not, you're not the only person that this is happening to. It happens to most newer traders, and that's why you, when you make these errors and they happen, you think, well, how silly was that? How stupid was that? Of course that was going to happen. But it's so important to keep to them, and that's why, you know, I trade with a framework, so to say. I know I have my levels, I have my targets. As long as you're sticking, or have that, you know, whether it's my method that I use or any other method, as long as you stick to that framework, it helps take out the need for the sort of gambling trade, or the need to always be in the market, because you feel comfortable on the sidelines knowing where it's going, or where it should be going, what it should be doing. That's following the script. You know when to jump in, so to say.
And they give you a sense of tranquility and peace of mind, because you know that you're following a frame of reference, that it's been written down, and there's harmony in your actions because you're following your plan, right? It's funny
exactly
because
that.
yeah.
But even then, you know, again, I refer to my group where I follow my plan, and you know the market will be following it, but it'll be in a degree where I'm not interested in trading. I'm rather observing. If the market does that, then I'll jump in. And everybody wants to trade it. And I think we don't need to trade this. It doesn't matter. It's more, if the market follows the script, and if the market goes there, this is the degree, this is the trade that I want. So a lot of that time I was spent looking at the market, looking for, even though I think I know where it's going and often goes in that direction, I'm still not interested in trading it. So it takes a certain setup, it takes certain market, or where it takes certain waves, degrees of where I want to trade. So even knowing where, or analyzing where markets should be going, it's still not a reason for me to trade a market. Where a lot of people want to trade every squiggle, because they, you know, they see a 2 and they see a 3 and they think it's going from there to there. It's not necessary. You don't have to trade it. You can watch it and go, right, it's followed the script. Now I want to enter the market, as opposed to guessing. You can let the market tell you when to enter, as opposed to hoping this level holds or hoping this works. You don't need to hope in a market. You need to plan accordingly and trade accordingly. If it's done that, then I can trade this against that, as opposed to, well, this level might hold, so I'm just going to go long, and if it doesn't, I'll stop out, and then you're just guessing. You don't need to guess in a market. The market tells you when you need to enter.
Yeah. Is there any lesson in particular that would stand out for you as the biggest one that you've learned over the years, and that if I were to put you in a time machine, you would tell your younger self, hey, watch this, because it's been teaching me a big lesson over the years?
No, I've got one for you. This is, I think, is important. I think many people fall into this category. Yeah, even I did when I started out. There's no holy grail in trading. There's no indicator that will make you profitable. There's no strategy that will make you profitable. You know, you spend a lot of time going, well, if I can learn moving averages, I'll be able to crack this market. Or if I can learn Elliot wave, or if I can learn Fibonacci, or if I can learn Dow theory or Wyckoff, whatever it is, there's no something of learning that's going to make you profitable. All these different technical analysis techniques and tools are to give you edges in the market, to give you an idea of where you're at and where the market's going, a strategy, so to say. But without risk management, you ain't going to get anywhere in this market. I'm sure many other people have spent years looking at the markets. They find the need to, I'm going to go learn this and now I'm going to be profitable. Yeah. Forget that holy grail, whether it's RSIs, MACD, OSMA, whatever it is, it does not exist in the market. It needs to be used in conjunction with risk management and a strong set of rules and a strong system that you have in place, which needs to be tested in all conditions. So spending all your time searching for that holy grail, searching for something that's going to make you money in these markets, it does not exist. There's nothing like that. Markets do not work like that.
Yeah, and ironically, many traders are thinking about how to make money, and they have a propensity to just be solely focused on the upside, whereas I think that what you've highlighted today, what you've been able to stress out to the public, is that you have to be first and foremost a good risk manager, someone who is actually going to be, defining the risk and letting the upside do its work and play and do the magic by itself. It's going to be taking care of itself, right? Would you agree with that?
It's the only way. And the reason I say that is you do one thing stupid. You don't put a stop in once and you can wipe out your whole account. You don't get second chances. Whereas if you take you keep your discipline, and you have your risk management, you don't risk more than 1% or 2%, whatever it is, no one trade can define you. And I think that's important. Never let one trade define your trading account, your week, your month, your year, your whole account. You know, you could probably, there are many stories I'm sure you can all share that has one trade, it took out 50% of the account and essentially damaged your account. That should not be allowed to happen. You got to prevent against taking those huge hits. And the only way to prevent that is risk management.
Yep.
I've heard people say, well, I don't need to use stop loss because the market always comes, it touches my stop loss, and then goes the other way. Well, the one time you don't use a stop loss and the market doesn't come back, your account's wiped out.
Correct. Yeah. And talking about stories, do you have any story in particular that you'd like to share with the audience?
So I've got two that I actually would like to share.
Just to put a final spin to the interview.
Yeah, they're two. One's the beginning of my trading career, and one is an election story, which I think is quite relative. So at the beginning of my trading career, when I just moved to London and I was market making and prop trading, I'd been there at the firm for a month. And it was a company trip to Portugal, which I couldn't go because I was still on my South African passport. I hadn't had to get visas. I couldn't sort them out in time. And my boss at the time was market making a product called Ionia, which is interest rate futures European. And it got very little action. He hardly got hit. It was sort of just on because it was a service they were running. And he gave me a 5-minute sort of rundown of what I need to do. And I understood it. I took it on board. So anyways, they leave. The next day comes and I turn on his black box system, do the parameters as said, and within the first 5 minutes the system gets hit. I'm like, that's strange. He doesn't get hit very often. So I turn it off, I hedge the position, turn it back on, and I get hit again. I turn it off, I hedge out, I turn it off, and I'm thinking this is very peculiar. I make sure the parameters are right, and I decide, okay, one last time I'm going to go on. I go on again and I get absolutely smashed through. Just a huge order, an all different contract. I'm scrambling around. So it's different months we trade with the futures contracts. I'm hedging it all out, turn it off. I'm thinking, it doesn't look that bad. Okay, after the last hit, it looked bad. After the first two, I was hardly offside, so it seemed okay. And then next thing I looked, I was significantly, I think it must be about $110,000 offside. And I had to call my boss. I hadn't been there for a month in the London office, and his phone was off because they were in Portugal. I had to then call the other boss who had the emergency line, and he just told me, turn it off, don't worry about it. And this was a Friday, so I leave for the day thinking, I don't know if I'm going to have a job on the Monday. And came into the office. Of course, I got a bollocking because I didn't listen. Well, I thought I listened, but there was one parameter of the 5 that didn't change. And luckily, my job was spared. I could have very easily have lost my job on that. And the market actually, we held on to the position, and I think they made about $200,000 from it in the end. So it was a massive, massive turnaround, which I took profit from. But I always remember the story because it could have cost me my job.
Yeah.
And it's just something that's always stayed with me. Just one tweak on the black box system that I wasn't listening to could have cost me my job. But
and at times, even though this position turned out to be profitable towards at the end, it's the hardest hits that are actually going to make you the most, going to be providing the most humbling experiences for a trader, isn't it?
But this was the whole reason that I still resonate with the story. Is it stuck with me? Not, maybe it gave me better risk management tools. Maybe it gave me the idea of make sure you know what you're doing. I probably count on, maybe once, twice, very rare that I'll fat finger in a market anymore because I'm so cautious before I place trade. I'm so adamant not to make those silly mistakes now. And that probably came from that story or that lesson as a young new trader, making that error. Mm-hmm. And I also want to share a story, which is actually, let's go to elections. I was trading the S&P on election night when Trump won. Yep. And obviously I knew the whole narrative of Trump in, stocks were down. Of course, I didn't believe that. And I was expecting a rebound in stocks. And it was about 4 a.m. London time. And I was trading and the market was dropping and it got to my key level. And I thought, you know what? I'm going to go long. It was half size, but I went long with a 15-point stop. And the market, after I entered, was gapping towards my price. And literally less than half a tick before my price, the market just stopped. And I was thinking, what is going on here? I realized it was limit down. Less than one tick before my stop, the market had closed or shut until it was going to be reopened in 10 minutes, half an hour. I didn't know. And I'm thinking, I'm looking at this and I'm going, inside, I'm like, I don't have a stop. This market could open up 50 points lower, 100 points lower. Mm-hmm. My stop is rendered useless. Wherever the market opens up, that's the price I'm getting. And, I must have been sweating. It's now 4 or 5 in the morning.
How long did it take until it reopened? Do you
about
remember?
20, 25 minutes. Okay. Maybe a bit longer. It felt like hours.
Yeah, for sure.
That feeling where you just don't have a stop and the market's already down. I mean, X amount, 100 points.
Were you thinking about hedging the position in any way in other markets that were open at the time in parallel?
I didn't actually.
Okay.
It was, again, we're talking 5 in the morning.
You were paralyzed.
Totally paralyzed.
Yes.
5 in the morning now, and I'm just looking. I mean, if I remember, all the US markets were shut. Perhaps I could have thought to hedge with other markets. I didn't.
Yeah. And long and behold, what happened?
As the market reopened, it just ripped higher, and I saw it go higher. It's like, I've dodged a bullet. I went from basically stopped out, sweating, to in profit. I saw profit. I sold it, thought you dodged a bullet, and that was the bottom of the market. Literally the bottom of the market. And we've rallied, who wants to guess how many thousands, how many hundreds of points?
Yeah, that was really, really the bottom. And I suppose there are no regrets, but rather a sense of, kind of like taking a victory lap. It felt like a triumph to you because you went from being exposed to massive downside if the market was to reopen with a major gap, like further gap down, to actually dodging that bullet, as you mentioned.
I was very annoyed with myself purely because as a trader, I should have known where the limit down level was.
Correct, yes.
My stop should not have been half a point below the limit down level. But again, this shows you the ill discipline. It's 5 o'clock in the morning. I'm watching this gapage. I'm watching the elections. I haven't slept. I see this. It's my level. I'm on my phone and I got my laptop out in the end, but I obviously wasn't in the office. And it just shows the ill discipline that could have cost me a fortune if this gapped another 50 points down, purely because I wasn't, I wasn't at my desk. I didn't go through my risk parameters. I saw the opportunity. I saw the price where it was. And I think that was a big lesson for me. At the end of the day, I was not one bit upset that I was so happy to get out for, green.
Yeah.
Hindsight's a wonderful thing that was the bottom of the market to this day. So perhaps we go into election night, we get a similar story. Perhaps Biden gets in and we get a big drop in my C wave that I showed on the charts, or perhaps Trump gets in and we get that big C wave down that fools everybody. But it's just a lesson, trading that sort of volatility is not clicking buttons, which I could have learned the hard way. I definitely dodged a bullet there.
Yeah, fantastic. Do you have any final words that you'd like to share with the audience before we wrap things up?
Yeah, well, if you enjoyed with what I have had to say, or
what can people expect from your mentorship room, and if in a few words, it'll be great if you can just remind them. So
my mentor room is very much a combination of things, and I think there's enough there that suits different people. I do provide daily analysis of the markets and chart requests for anybody who's looking at specific markets or wants to know more about the markets I primarily trade.
Yep.
I've been doing a lot of teaching as well, showing my methods. And, if I had somebody that I could have learned from, or someone I could ask questions to when I was studying, it would have saved me years on my trading career path. Yep. So I'm very hands-on. I answer questions as close to real time as I can. I'm involved daily within the room. So whether you're looking to get trading ideas, but whether you're looking to understand my view on the market or want to capitalize or trade those views, or you're willing to learn how to trade, then my room will be beneficial for you. But I will end with something that's been my current theme. My theme throughout is that it doesn't matter what method you use. It doesn't matter if you follow my trades or if you try to learn. If you do not apply risk management, doesn't matter how good the analysis is, even if it's spot on, you will end up losing money. So just being in my room doesn't mean you'll get trade setups that work all the time. And even if they do work, as a trader, you need to understand, it doesn't mean you can put a stop where you want, or it doesn't mean you can trade 5 times the size, because you will get run over.
Yeah. Yeah.
So it's important to understand that you need to have your risk management. And I will just go actually one thing, just sort of a nice analogy that I do like to use, but I haven't really touched on, which I should have. Trading essentially, we say is a game of probabilities. We say, in essence, you need to place your chips when the odds are in your favor. And I go to a coin, flip of a coin, heads or tails, it's 50-50 which outcome it's going to land on. But if you told me, Ivan, you'll pay me $20 every time it lands on head, and I'm going to pay you $10 every time it lands on tails, if we take that bet, I'll take that bet all day, every day, because I know if we flip this coin 10 times, 50 times, 100 times, 200 times, the more we flip this coin, I will win over time. But if we decide to take that bet and I go, great, I put my whole account on the line the first time, I can lose that bet and then my account's wiped out. So that's why the system is so important. It's so important that I know I have an edge within these markets. I know if I don't risk more than 1% over time, I will make money doing what I'm doing, as it's shown over the years.
Yep.
Of course, it's a market. You can't always make money, but history has shown me that my system works and that my system is profitable, but I don't know which setup's going to work. I don't know if this one's going to work. So that's why I can't increase my size and risk 5% or risk 10%, because I could lose 10 in a row and my account's wiped out. So it's important to understand that if you can get a 50% setup and you get 2-to-1 risk reward, you take that setup all the time. You don't know if it's going to work or not going to work, but keep repeating those setups, whether it's 3-to-1, whether it's 5-to-1, whether it's 1.5-to-1, whether it's 2-to-1, whatever it is, as long as it's better than 1-to-1, if you keep repeating that process over time, your system, you give yourself the best shot to make money in these markets.
Correct. It's a great analogy. And just to finalize, I was just going through our Discord channel. We have a section called testimonials. And I got to say that as of late, you've been dominating. There's a lot of people that are talking very highly of your service. And that obviously speaks volumes of all you do for those traders that want to learn. And here's one thing that Trader Julian said about you as a mentor. For anyone who's tried Greg's room, and if you're looking to understand Elliot waves or just looking for a system that works and would like a super experienced trader to help you all the way, he is the guy. And he just went on and on and on. So this is a testament of what you've been able to put together. I know that there is definitely a certain degree of secrecy when it comes to, or privacy, if you will, when it comes to the amount that you want to be sharing. For those that are not yet interested and want to go through, there's going to be a 2-week free trial. If you happen to actually wanting to, dip your toes into this room. And yeah, it's been a great time. We've gone for more than 1 hour. I appreciate your time, Greg. And yeah,
Thank
more
you,
exciting things to come in the foreseeable future for sure.
Thank you very much.
Thank you.
Cheers.
That's it.
Bye.